So our next moderator is one that is close to heart. David Shafrir will be joining us in just a moment. Is a co-founder of mine in various business ventures. Dave started his career in merchant banking and has seen numerous successes as a serial entrepreneur involved in creating, scaling, and exiting several technology companies. After that, he kind of made his foray more into the digital asset and financial market space. Dave was my co-founder at Secure Digital Markets. Together, we've grown SDM to become Canada's largest digital asset brokerage. We together have completed several $1 billion of digital asset transactions and service a very wide and esteemed suite of institutions globally, give them access to the digital asset industry. Together our kind of mission there was to help facilitate the on and off ramps in the space, which I think will be an important topic to discuss next, as now that there is free-flowing institutional capital, the next panel, which discusses alternative asset investments for family offices, will really give us some insight into how that capital gets utilized, structured. We'll be hearing from some panelists discussing strategies seeking alpha, strategies protecting risk, and how they can look as well at public market vehicles to help see return in the ever-growing all asset space by specialization on blockchain and digital assets. Again, just to wrap that up, David currently sits as the executive chairman at GDA, where he's spearheading various capital markets and growth initiatives. And Dave, why don't you take it away?
Zachary, thank you for that lovely intro and great breakdown of GDA and Secure Digital Markets rise to our current situation. And I'd like to thank my esteemed panelists for joining me today. The alternative asset landscape has certainly seen a very exciting growth over the last several years. And with 2020 definitely being a unprecedented year, both economically and generally worldwide with the current COVID situation. It's been a tumultuous time, both for investors as well as fund managers and owners. Across the landscape, from digital and alternative assets to equity markets, we've seen a drop between 30 and 50% during the March liquidity crunch. And thankfully, we established new yearly highs in the month of August, coupling that with interest rates being at a 20-year low. We've seen some very different strategies come into play, both looking at fixed income instruments and the bond market becoming less attractive. Now, this has drawn billions of dollars into the alternative asset space, specifically seeing new products in the digital asset market, such as DeFi banking protocols, make a huge surge and find new homes in both retail and institutional homes. With that said, I think we're seeing some coupling of diversification of portfolios. 2003 until today, we've seen an increase of nearly $9 trillion in alternative asset allocation. And this is comprising now nearly 12% of addressable investable market cap. So we're seeing some very exciting numbers and very interesting movements in both traditional family office and alternative asset funds. And I think we're definitely encouraged by the activity towards the latter half of this year. In closing, I think we can safely say 2020 has been unlike anything any of us have ever seen. And it becomes more and more important to discuss and consider the preservation and protection, as well as diversification of our capital and how we allocate it. I can personally say that I'm heavily involved in the crypto market, but I started off rather bearish several years ago, taking that 1% attitude, and I've been pushing up into double digits since then. And I'm very excited and quite honored actually to be joined by an esteemed panelist group of managers, fund owners, and longstanding members of the industry. So I'll take a moment to briefly introduce my panel, and then we can jump into a conversation that I think is relevant to all of our attendees. First off, I'd like to introduce James Haft, founder of PAL Capital. James is a well-known member of the alternative asset and digital asset space, having involvement in more than 100 venture-backed and blockchain-based entities. James was also the co-founder of the Crypto Oracle, Crypto Mondays, and is a well-known member in the crypto scene across North America. Enzo Villani, CEO and Chief Investment Officer at Alpha Sigma Capital, has a storied career in the traditional and now alternative investment market. He was involved in the key consolidation of 10 plus companies across 4 continents, representing over 5,000 public altcoin market capital, public companies, and raising in an excess, I believe, of almost $500 million. Next, we have Dr. Nicholas Verwillhan, a lead and senior investment advisor at LEMVI. Dr. Verwhilghen enjoys a $15 billion asset under management, multi-manager hedge fund status in the past, and is Switzerland's first dedicated institutional investor focused in alternative assets and digital assets. And finally, we have David Yoon, CEO and co-founder at NeverSink Capital. David has a longstanding experience with McKinsey Management as a consultant before stepping into a equity strategy role at MIO Partners, which is the hedge fund arm of McKinsey, managing over $1 billion in investments, and focused and specialized in algorithmic trading strategies for fund startups. So, gentlemen, I think I'm wearing the small hat in the room here, but nonetheless, it's very nice to have everyone join. Look, I think we can turn this these last few months into a positive spin into the alternative asset space. And I'd like to ask everyone a couple of questions and get this conversation started. So, James, I'll start with you. Coming out of the gate in Q4 and moving into 2021, what do you see happening with PAL Capital, and how do you see the effect of public markets playing on your investment thesis and strategy moving forward?
First of all, David, thank you for having us here. We appreciate you guys, and we appreciate GDA and all you guys are doing in the industry. So thank you.
Thank you. Much appreciated.
And you clean up nicely, by the way.
Likewise.
Thank you.
And I don't think many of us have left our houses for some time. So
exactly. I'm up in Vermont in the mountains. Don't tell anybody. So it's interesting. These trends, they don't go in straight lines, right? They go. They're bumpy up and down. If you looked at the old example of Amazon, right? Back when I first started PAL Capital in 1996 to focus on the digitization of information and the impact it was going to have on business models and entrepreneurship and capital formation, Amazon was going from 5 to 100 to 10 to 100, and each day you'd read the newspaper, and one day it was going broke because it was the dumbest idea ever and they were never going to make a profit, and the next day it was brilliant because they were going to not spend any taxes and not have profits because they were going to reinvest in R&D, right? And then they were going to reinvent distribution, and then Walmart was going to kill them. And it was every day your neck was just getting hurt trying to watch this stuff. And now when you look back at Amazon, it's up 1,700%, since 2000, and you can't see those gyrations that you thought were earth-shattering. You can't even see them on the chart anymore, right? They don't show up as significant movements in the long-term chart. And we're kind of going through that creation moment in digital assets right now, right? The interest rates aren't low, they're negative, right? If I put my money in the bank, they charge me more in fees than I'm making, from them. They're charging me for the honor of holding my money. Right? And so if I'm thinking about wealth preservation, and I'm thinking about protecting myself against inflation, deflation, stagflation, and all the things that are about to whack us, and send us flying, you got to think about diversifying, and you got to think about making sure that you have, enough of a diversified portfolio that you can make it through whatever the storm is. And the truth is, none of us are smart enough to know exactly what's going to happen. So
I think taking that note just quickly on, getting whacked with something. I think we've got a fairly significant event happening at the beginning of November. And Enzo, I'm curious what your sentiments are as a fund manager and someone who's been in the markets for a number of years, not necessarily just in traditional, obviously now in the alternative space, heavily focused in digital. What do you think the managers across the market are considering with the 2020 election coming up and the economic shift that may or may not join it, but I think it's safe to say that we'll see some ripples in the market no matter what the outcome is.
Yeah, so again, thanks for actually having us here. I think this year especially, we are seeing that the net effect of this kind of tunneling of social media, kind of really getting bases very, very riled up, is really just a strategy, to be honest with you. It's an election strategy because they know that they want to get everyone out to vote, and the base is the only way to do it because the country is so actually divided. So they're really talking to the most, to be honestly, the most radical and the most fringe part of the markets. And then, for the market, for their manager, you just have to like take a step back. You can't be going down the rabbit hole and listening to all of the rhetoric, because a lot of it is purely rhetoric, and a lot of it, I think, is a lot of banter. And you have to look at what's really happening. And what's happening is the currency is being actually the base. So you have to be extremely careful about that. So real estate assets, you have to be careful about those, especially if you're in more of the kind of commercial lending. I'm sorry, the commercial rentals side, or you own strip malls. It's a lot of large family offices own a lot of real estate, right? That's the way they want to preserve wealth. It's still the safest way to actually preserve wealth and grow wealth. But for us, my parents were really good at real estate. I'm not that into it. I think actually the digital assets kind of gives us the best of both worlds, where we have some store value opportunities like Bitcoin. And with the election, I just see it as a hedge. I mean, I think right now we're starting to see a little bit of a decoupling between the Ethereum. So there's the Ethereum with all of the ERC20s. Once it goes down, they correlate. Once it goes up, it starts to move based on the projects that they're associated with, which should maybe too much detail for this panel. But the other thing is that we're seeing—
You're going down the rabbit hole. That's what we're here for.
We're seeing Bitcoin,
don't hesitate. Keep going.
But we're seeing Bitcoin non-correlate, start to decorrelate against Ethereum and the S&P. That doesn't happen yet. For some reason, Bitcoin has been correlating to the S&P. No one really understands why. I mean, I guess we do know why, but it shouldn't happen.
It's an intellectual correlation more than anything else. We're not seeing.
Yeah, I think it's a moment.
We're trying to cut the strings, but we're not seeing it happen.
Gold's the same problem. The funny thing is, when COVID hit, everybody rushed to the dollar, and it's like, wait a second, we're printing more dollars than ever, and everyone's rushing to the dollar. As a fund, I have to also put my stuff in dollars or USDC because that's the way that I'm measured. But if I didn't have to be measured that way, I'd probably leave it in BTC.
Well, I think that's an interesting, point. We're seeing guys like Michael Saylor talk about how they've poured in hundreds of millions of dollars versus keeping them in cash on their books into Bitcoin. And I think that, that's pushing the market adoption and the further understanding of the realization that Bitcoin is not just a quote unquote flash in the pan, but this is a true store of value with the alternative to lack of volatility or opposition to volatility being in the stable coins that I think we had a great conversation about in one of the earlier panels, specifically in Will Bartlett's presentation, for those that are unfamiliar. Nicholas, I'm curious, with all of this being said, what do you think will be the catalyst to drive large-scale institutional adoption into the digital asset space?
The first driver will be custody. Very clearly, having institutional custody is one of the big things that you need to tackle. Was also the case for me to move in this market, and kind of feeling comfortable. What we do is just, extract arbitrage and relative value opportunities with tremendous success. But the point is, if you can't get institutional type custody done, then there's no point, right? I mean, the day you wake up, you know, you're just dead. You know, people running with the money, no matter how much multi-sig you have. And that's something that, you know, it's just in the institutional world, a no-go. That's in place today. So you can actually do that, and that is very encouraging. I'm actually surprised to see why not more institutions are picking that up and understanding that custody has made great progress over the last year or so. So that's one. And the second will be the hunt for alternative niche premia. You know, it's all about the sucking of risk premia, right? That's what institutional investors are looking for. And everything they have so far in their portfolio in size is really very, very correlated, right?
Yeah.
And as long as interest rates don't move, it's quite okay. But if they start moving, then equities and bonds and everything is the same direction. So whatever you do, but by the way, real estate is going to be a catastrophe. So better rates not move, otherwise everything goes the same way. And that's why you want to look for strategies that can stomach a lot of volatility like we do. We can take 50% up and down moves in a few days, and even benefiting in a large way. And the whole story now is making investors understand that, for example, a niche premia can be extracted from the crypto space, has made its proof in very volatile times, and that these premia can be extracted. And that's a marketing issue, given that you settle the custody side. So yeah, there's a lot more education to do in this market, and there's some other niche premia coming up. So I think
makes sense.
there will be something to do.
David, I'm curious, you know, with this conversation focused around, you know, the various components of volatility that are plaguing the market, both digital alternative, more traditional alternative, and now into currency risks and other, you know, international episodes, black swan episodes like COVID coming through, and all of a sudden, you know, the market kind of somewhat turning upside down. What role do you see machine learning playing in the crypto asset management world? And I'm curious as to how you see that evolving in terms of hedging and managing risk going forward.
The fundamental difference of, first of all, thank you for having us on the panel. And I enjoyed the first 4 panels incredibly. The way we look at it is that, you know, more and more hedge fund, traditional, if you can use just traditional here, hedge fund strategies are being ported over to crypto. We're so far on the edges of what is considered mainstream that you can consider alternative assets no longer alternative, but more traditional.
Traditional alternative. It's a new phrase we're coining here at the conference.
Exactly. Well, yeah, kind of the plain vanilla alternatives. We see, and we have a particular quantitative bent to the strategy. So excuse us if you are in kind of the more hand trading or more of the traditional kind of day trading. But the way we see it is that there's an enormous amount of quantitative strategies that cannot be ported as of yet. And those are namely strategies like stat arb, which is very popular, or used to be much more popular, but still a big chunk of quantitative strategies in traditional hedge funds. That can't be ported over to cryptos because we don't have a fundamental model of value. So when we're faced with such the lack of data, the lack of consistent data from the exchanges, as well as this enormous lacuna in the gap of fundamental models, we turn to more sophisticated methods, and that's where machine learning comes in. We don't think it's possible to have a long-term research agenda without machine learning, but especially for cryptocurrencies and digital assets, it's not possible, we don't think, because you don't have some of the fundamental value drivers that govern what something is worth in cryptos as of yet. I think you can imagine, and we're looking at this as well, you can imagine kind of the activity on a blockchain could suffice for some sort of value marker, but we're not there yet. We haven't seen anything credible that anyone is trading on that's based on that value.
Interesting. Enzo, I'm curious, this kind of leads into a more basic fundamental question, but looking at traditional family offices and their slow but steady and consistent foray into the digital asset space, what do you see as being necessity for a digital asset that every money manager portfolio should hold? And why are you, beyond, I mean, we can talk ad nauseum about the, Bitcoin, both as a store of value, but also as a product that's received a lot of attention worldwide over the last number of years. But I know that, Alpha Sigma Capital has focused more and more in the alternative and alternative within the alternative space.
The alternative to the alternative to the alternative.
There you go. So we can fall into a little bit of an inception if we don't be careful there. But but I'm curious, what are you thinking the money managers should be holding right now, and from a medium and long term, where are you seeing this? And I know James will have plenty to jump in and retort with here. This is a conversation. I just wanted to kind of get us all on the same page, and let's feel free to chime in, guys, and have it as a convo.
Yeah, sure. So I'll kick it off. So basically, we're doing actually fundamental research, like these things are public equities at some level, and we started doing it because my background is actually public equities, and I rolled out. What I did was I've always been in the public company services space for NASDAQ, and then actually afterwards, so in investor relations, research, proxy voting. And tokens have some of those components as an equity. It's just that we don't have completely, like, I would say, the currency like Black-Scholes model yet, right? I think that's where we're missing some of this, and someone smarter than me has to come up with that. But you do have some voting and some basic kind of governance functions. You do have people who are a community and their stakeholders as buyers or sellers of the product, as well as potentially holders of the actual token, which could represent some type of revenue share, an asset class of something like that. So when we started looking at these companies, like a great example is Quant. I think Quant's a great example. Celsius is a great example, and actually Voyager. These are three companies that I kind of put on the forefront. Quant is basically like Ripple, except it's trading at a $300 million or no, $150 million market cap on the token side. It's a private equity investment on the private equity side, but their board includes people from the Rockefeller Foundation as well as the vice chairman of Comcast. You have a person who is the head of cybersecurity at the Bank of England. The company is generating revenue. They have hundreds of customers. They're partnered with CNET, which is the largest banking network system in Europe, with 1,500 banks and different kind of financial institutions attached to it. They're partnerships.
You're seeing real traditional players adopting. Yeah.
Right. So I'm just using them as a great example. Celsius, 6 to 7 billion, is crossing over 200,000 accounts. It's profitable. These are real companies. So we started saying to them, you know what, you're pretty much a public company. Why don't you start acting like one? And then we'll come and we'll do research, real research, independent, looking at you on a fundamental basis. We'll do the quarterly updates. No one's paying for this. We're doing it because we're the investor, right?
Well, I think that you're just touching on a very important point, which I think for those in the attendees to understand with crypto, there's been a long-standing kind of underlying thought of crypto being, mysterious, and that it has, unknown players, bad actors within the space. But I think what Enzo and the rest of the panel here have been, dedicating the latter parts of their career here within the digital asset space is to create that self-regulated industry where we're providing information, making it publicly available, which is one of the ethos of the blockchain to begin with. That is the whole purpose of the blockchain, to make information on a ledger and available to everyone. James, I saw you were going to jump in there for a second. I kind of cut you off before you spoke. You're on mute, so just giving you the heads up.
Okay, I think I could get rid of the mute. So, what's interesting is that we talk about the subject here is alternative investments, right? So I've been doing alternative investments for 30 years. And originally it was, equities in businesses in China that had to be filtered through BVI entities to be accessible on the New York Stock Exchange, right? And now that's common. right? And master limited partnerships were alternative assets to fund oil and gas, and now they're mainstream. So you have to remember that alternative assets don't stay alternative assets forever. They're the on-ramp into, they're the sandbox that the successful ones become mainstreamed as you go forward. And so what you have right now is a set of markets globally that just aren't working, right? The regulation killed the public markets. It killed the IPO. It killed entrepreneurship and access to liquid finance for people who are trying to do capital formation and and create new industries. And so, humanity's been searching for, how do we solve this? How do we get access to capital without having to be a slave to a venture capitalist or having to spend millions of dollars to try and list, in a public market that doesn't even want us? And so this is just the latest iteration of what's happening there. And so, when we talk about how, classic equities are valued, and the Miller-Modigliani model, and the, and Black-Scholes, what happens is that those come in as concepts that are relevant for a period of time, and we start to rely on them as if they're absolute and permanent, and they're not. And just like the asset class isn't permanent, the way you analyze them isn't permanent. As a matter of fact, when everyone starts to settle upon a common set of ways to value, that system then becomes vulnerable to attack and being wrong, because everyone's essentially a lemming and not looking at the real opportunity. And the opportunity becomes understanding how that system is wrong and going to change in the future. And that's why you have alternative investments, right? And that's what's happening right now, is that there's no yield on your fixed income in the bank. That the truth is, we understand now that the accounting systems and the way that we value public stocks is complete baloney, right? The way, public disclosure is public obfuscation, not public disclosure, right? So the idea that you're protected by the SEC, and the SEC protects you because you have a lot of money, so therefore you're an intelligent investor because you're rich, is just silly, right? And so what's happened now is that the floodgates have opened now to a new way of looking at things, where people can start to invest where their critical advantages are. And some of these things will be scams, and some of these things will be real and will have feet in the future. And what we're doing right now is the messy job of sorting our way through that, right?
Which is what historically has been the pathway that these markets have followed.
And this is where the excess beta is. This is where the excess alpha is, right? This is where you make, you allocate those returns that that Nicholas was talking about.
Yeah, if I may jump in here from the institutional side, it's really giving investors access to a risk premium, right? That's really what it is. Second, do it safe, and then do it in size. And risk premia, there's a few around in the space. I've had a hard time, thinking that myself I could predict whether these markets go down or not. And doing that, I felt like, wow, the opportunities are just crazy to do relative value and arbitrage. And it looks a bit like the very early days in hedge funds in the 90s, where you could really suck out this premium like there's no tomorrow. I mean, it's just unbelievable how the mispricing is done and how you can extract value from that. And there's constantly new instruments coming, so this market is evolving. I always thought it would be impossible to extract it for liquidity reasons, and I'm finding more and more liquidity. So there's really something to do. The only thing that I would give as a warning, other than you have to tackle the custody side, and you really have to make things safe. If accidents happen on the operational risk side, that would be dramatic and would have dramatic consequences for institutional investors, just leaving this market for a long time. But I also would not go against the superpowers, right? If you start to, try to get that power, that I think is a bit early for this market, printing money, doing the role of the fractional reserve banking system and trying to replicate it. The second you try to do that with any currency, you will have an issue, because then you fight the big powers, and I'm pretty sure that major institutions wouldn't want to do so. But there is plenty opportunity along the way, and I find that very exciting. And if you can do alpha on top, is cool. But you can do it just with the beta, just extracting.
So yeah, sorry, James, I'll let you chime in there for a minute, and then I'm going to pose a question to the group. I know that we're running up towards the end of our panel time. I wish we had an endless amount of time to continue this discussion, but I think we'll continue this in an additional forum similar to this in the next online symposium. But sorry, James, go ahead, and then I'll pose a question to the group.
You have to be careful about looking at institutions and how you define them and how people invest their money, because I think actually the form of what an institution is and how people are going to invest their money is fundamentally changing. And so, you know, I understand that honestly, obviously, I understand the custody issue and the risk issue, but that's just the argument for new forms of insurance.
Yeah.
And,
I mean, yeah, and I think I couldn't agree more. And I think the traditional markets can only play a certain degree of correlation, both in value as well as in governance. And so now what Enzo was talking about is, you know, the industry regulating itself is always going to be a great spearhead. Eventually, we're going to see regulatory framework come through. And that's going to lead me to my last question here that I'll pose to the four panelists. Will central banks' intervention in the digital asset space help or hurt the industry's adoption? You know, we're seeing that come across multiple jurisdictions worldwide, and I'm curious as to what the four of you think of that and how it'll affect the market.
I'll start off with it will help. So that's why I brought up quant, because what's happening is that the powers that be are getting into the asset class.
Right.
If you look at, and you know what, once the asset class becomes of size, most of the institutional money is not going to go, I don't want to, you know, it won't go to some of the existing platforms.
Right.
I'm not saying it because I don't like the existing platforms. We use them all the time, but they're a deregulated, you know.
Well, we know that there's going to be new that come up that are more, traditionally governed. Let's call it.
They're not regulated, so we have to be very. It's true, custody regulation. It's all, but it's all happening. Everything's moving ahead, and really, what we do is we siphon through it. This is the early days. So I think for us, you know, it's good when the adoption happens. Here's something that you have to understand. The comptroller of the currency in the United States right now was the former general counsel of Coinbase. I'll leave it at that.
There you go. David, I saw you wanted to jump in for a moment there.
I think it's just going to reduce volatility. That's great for business, less good for traders, but great for business, right?
Well, and that's, I think, what I think that has to be a healthy mix of both. Gentlemen, I want to thank you for the time. I think each one of you brings a unique but well-defined perspective here. And it certainly has been an interesting conversation. I appreciate from the various places around the world joining us. I know Zachary is anxious to usher me off the stage, despite how good looking this group is. We'll hand the mic back, and we'll continue along with our fireside chat that I think is coming up in a moment.
Thank you very much.
Thank you for joining us.
Thank you.
Thank you.
Guys,
Appreciate it.